Good afternoon, everyone, and thank you for joining us for another installment of our Thursday webinar series. We do webinars every other Thursday, and we're glad you could join us today for our presentation on policy loan rescue using mirrored loans. And before we get started, I'd like to give a quick commercial about InsMax, who we are and what we do. We share insurance ideas and concepts that solve real-life problems. We work for our advisors. We have 20 years experience in the brokerage business, and we work with more than 30 of the major insurance companies in the industry. We provide trading and consumer-approved marketing content so you can approach your clients. We handle your contracting and licensing when your clients want to implement a plan. We handle pre-underwriting to uncover and address your client's specific impairments and determine the best insurance company for their risk. We give our advisors all the forms needed to complete applications, and we review completed forms for errors and omissions. We handle the entire underwriting process, from application submission and scheduling exams to obtaining medical records and negotiating better offers with the underwriters. So in short, we're a full-service brokerage company that you can trust. I like to say we're insurance experts, so you don't have to be. So let's get into today's topic. There's several contributing factors that can negatively impact an insurance policy, and in every insurance company's investment portfolio are U.S. Treasuries and bonds. These two items can make up 75% of the total portfolio, and the returns have been dropping steadily for decades. We've been in this low interest rate environment for the past 10 years and have seen record lows recently. Carriers are being forced to drop interest rates in the products and release newer products with even lower interest rates. Current assumption products issued 15 to 20 years ago are at great risk due to the lower than expected interest rates, but they're not the only type of product that's being affected. Whole life policies also have experienced decreased performance. So this chart shows the movement of dividends between 8 major carriers in the whole life marketplace. These dividend scales were over 8% or even 9% in some cases, and are now in the 4.5% to 6% range. That's a decrease of about 30 to 55% over time. And these rates aren't going to improve anytime soon either. As the bonds and treasuries mature and drop off the books, they're replaced by ones with lower yields. It may take 10 years or more of an increasing interest rate environment before these rates can even reverse this trend. So whole life policies, they've been around for 150 years, and it's no surprise they're still very popular today, comprising about 37% of industry sales in terms of annualized premium. This type of product is viewed as safe and secure, but does have its risks depending on how it's proposed and sold to clients. Whole life policies are designed to have premiums paid every year and will endow at age 100 or 121 without receiving any dividends. Remember, dividends are not guaranteed and have been declining as we've seen. The premium's guaranteed, the cash value is guaranteed, and the death benefit's guaranteed, but with those guarantees comes additional cost. Whole life is usually the most expensive policy type that you can buy. To overcome this, some whole life agents show clients that it might cost more upfront, but the policy dividends can take over paying the premium at some point. This technique is called a premium offset and is sometimes referred to as a natural vanish. So here's an example of a premium offset. The annual premium for this $500,000 policy is $8,500. And the premium must be paid again in all years. In this design, the client retires at 65, and the dividend has increased to a point where it's now greater than the planned premium. At this point, the dividend option can be changed to pay the premiums. When this happens, the death benefit will level off, and the policy will continue to accumulate cash value. Any surplus dividends can be used to buy paid-up additions and increase the death benefit. This example assumes that the dividend scale remains the same from day one when it was first sold. Now let's look at the same design, assuming a 50% lower dividend scale. So in this example, the client's still going to pay premium until age 65 when they're expecting to stop making premium payments. But the dividend scale has been reduced and the annual dividend no longer exceeds the premium. The difference must still be paid. And this is where most people get caught unaware. They remember their insurance agent telling them that the policy is going to take over the payments, and they really don't know all the details. This policy, like most, will start the process of automatic premium loans for any premium unpaid by the dividend. These loans will accumulate with interest and slow down the cash accumulation and even cause the death benefit and cash value to erode over time. So let's take a look at APLs. Again, whole life premiums are payable for your whole life. When premium payments aren't paid by you or your dividend, most policies automatically borrow against the cash value to pay the premium. This can occur without the policy owner noticing and begin to accumulate to significant amounts. What makes it worse is that the policy loan rate in these whole life type policies can be as high as 8%. Let's look at some different types of loan recognition. In a whole life policy, you have direct and non-direct loan recognition. Direct loan recognition is where any amount you borrow plus any accrued loan interest no longer earns a dividend. This can severely slow down the policy's cash accumulation potential. Non-direct recognition is the opposite. You continue to earn a dividend even on the amount of cash that you borrowed against. This can allow cash to continue growing even when being borrowed against. Even if you have a non-direct recognition loan, in simplistic terms, if you have an 8% loan rate and a 5% dividend scale, you've got a negative 3% charge eating away at your policy. So let's talk about the long-term effects that a policy loan can have on your policy. Policy loans at first might be small and manageable, but over time, when they go unnoticed, they can accumulate to become significant. They'll slow down the cash accumulation value. The death benefit will decrease because at death, the loan is repaid from the death benefit, leaving the beneficiaries with a net death benefit. Premiums for the policy will need to be increased. Many times, the first signal that there's a problem is a lapse notice or a surprise premium invoice. Lastly, there's the potential tax liability. When policies lapse with a loan, any loan balance that exceeds the cost basis is treated as ordinary income. So how do you find out if your policy is in trouble? Well, policy review. Every policy should be reviewed periodically. Clients' needs may have changed over time. The insurance company may have changed the policy's rates. And maybe there's even better product out there with additional benefits and features that weren't offered in the past. A policy review can help you identify issues with the policy and allow you time to make modifications or look at alternatives before it's too late. So let's take a look at a case study. So this policy was purchased 23 years ago. It was a whole life policy, and the client stopped paying premiums after 15 years by doing a premium offset. The dividends were greater than the premiums, but since that time, the carrier has decreased their dividend scale, causing the policy to make automatic premium loans. He doesn't want additional out-of-pocket costs, but wants to be able to maintain this death benefit. So he still has a $2.8 million policy that has significant cash value accumulated, and a little bit over 20% of that cash value has been loaned to pay the policy's premium. We use a 1035 exchange to move him from a whole life policy into an indexed universal life policy. The loan moves with him to the new company, and in the second year, he makes a tax-free withdrawal equivalent to the outstanding loan, and then uses that withdrawal to repay and eliminate the loan while providing a larger death benefit and not requiring him to pay any additional premium. So here's another case study. This is a client that wants to prevent a tax bill. In this case, we've got a business owner that stopped making premium payments years ago, and he's taken loans recently to offset decreases in sales. So this might be a very common scenario right now. The policy is on the verge of lapsing and causing a taxable event. His current death benefit is $472,000, and there's $299,000 of loan against $300,000 of cash value. In order for him to continue this policy, it would cost him $30,000 per year. And if he lets the policy lapse, there's going to be $240,000 of ordinary income since his cost basis is only $60,000. On top of that, if the policy lapses, there's no death benefit for the family. So our solution involves him paying down part of the loan immediately. In this case, he's going to pay $39,000. We then do a 1035 exchange into a new IUL policy where he'll pay $10,000 in loan repayments for 5 years. In year 6, he'll start using withdrawals from the new policy to continue making loan repayments. And there's significant out-of-pocket costs to prevent a policy lapse. even if the cost to move to another carrier is equivalent to just paying the taxes due at the time of lapse, you're still able to spread the cost over 5 years, have a death benefit there remaining for the family, even though the death benefit's slowly decreasing over time. But the main thing here is that we wanted to prevent the policy from lapsing and allow him to get some value for what it takes to correct his policy. So what options do we have dealing with policy loans? You could do nothing and watch the policy erode until it lapses. You could start paying something out of pocket, either loan repayments to start bringing the loan down, or start paying all the interest out of pocket to freeze the loan at its current level. You can look at modifications to the existing policies, such as reducing the death benefit or trying to turn the policy into a reduced paid-up policy. You can see if the policy can support a withdrawal and use that withdrawal to repay your loan. Or lastly, you can look at a 1035 to a new insurance company. You bring the loan balance with you and incorporate some of the above. So we have several companies that can accept 1035 exchanges with loan balances. The ratio of the loan to accumulation value is going to vary along with the products and the type, but we've got many options available to us here. And I'd like to take a moment to point out Prudential. Their product performs very well when bringing over a loan balance, and some of the presentation slides that were provided to us today were from Prudential. So we've got great resources that Prudential has made available to us, and they're a very valued carrier partner. So we like to take advantage of their resources when we can. So how do we start the process? You want to ask your clients if they have existing insurance policies. It may sound basic, but that's the start of any conversation. You know, I don't see anything listed here in the asset category for life insurance. Do you have any? To help us, we need the copy of the most recent policy statement so we can identify what type of policy we're dealing with. If you're not the writing agent or authorized on the policy, we need to get a signed third-party authorization by the owner. And what we really need is for you to discuss the purpose of the policy with the owner. It's really important that if we're redesigning and we're ordering in-force illustrations that we know what the goals are and how to help achieve those goals. And then we'll compare alternatives in a new policy versus what it takes to correct the existing policy. And once you make a presentation to the client, we're there to help you implement the plan. So with that, I'd just like to thank everyone for joining us today. We'd really like to help you with opportunities that we're sure you're going to uncover. We encourage you to reach out to us to discuss your next case. You can call us at 610-382-5000 or email us at info@insmax.com. Thank you, everyone, and